Stocks did not continue to rise today, so a few little cracks in the sidewalk showing up in today's moves, especially some pretty decent moves in other markets besides stocks that obviously relate to markets. So I'm going to break down those moves and what our expectations are and how that might turn into something more than just an 8-day moving average pullback, which is pretty much all we've seen on any weakness previously. Can it turn into more? Can it get to the 17? Can it get beyond that? So we're going to break down kind of the signs to watch for and what some of these other markets are saying and why we should care about it. And then I'm also going to take a look at our trade idea for a stock that, again, that's on a nice, good trend itself, kind of bucking the trend of some of its other counterparts. But as you know, I want to be able to give it some room to the upside if we stay bullish, follow its trend, but to the downside in case there's some more weakness. So it's kind of a pretty popular thing to do right now, considering the type of market we're in. So that's what we're going to look at for our trade idea today. So let's go ahead and get started. Today is Wednesday, August the 19th, 2020. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. You can see for the second time here in a couple of weeks, we've gotten a bullish intermediate confirmation signal. Last time, and we had a little brief one here, but between these two, you notice that this is very similar to the one that we had on August 11th because the near-term line also just barely got to 50. And didn't cross. They did on the NASDAQ, but it didn't cross on the S&P. It got right to 50.5. Well, today we got to 50.7. So very, very similar with an oversold momentum line, near-term line almost there. The difference between this go-around is the near-term peaks here didn't get nearly as high. But still, you know, a 16-day near-term run. You know, this intermediate confirmation signal led us up to about a week rally. You know, by the time we got done, 33.33 all the way up to 33.89, so about a 55 point move higher on that near-term leg. Unlikely that we'll get a very similar move here because now we're like talking about 20-day run. And you also notice too, like the Dow Jones Industrial Average, its near-term. See, it didn't pull down either when on August the 11th. But now it's the near-term line significantly down there. It also has that intermediate confirmation signal. The Russell 2000 is the same way. It did drop on August the 11th eventually. It popped back up briefly and formed this bearish near-term high point. You know, the momentum or the near-term line didn't even get above the market sentiment line, and then has already turned lower. So some weakness, some more significant weakness on the Dow and the Russell, which again are more economically sensitive than like the S&P and the NASDAQ 100 are. The NASDAQ 100 is still very positive. If I were to activate this and move it up to today's high point, then you can see, you know, we're still, I mean, look at the 38% line is lining up with the old high, pre-COVID high point. I mean, that's how big of a move. And like we're not going to like be downtrending anytime soon. We might get some weakness here or there, and there's even a little bit of an intermediate divergence. We had one over here as well. We've had a cluster. We're very mature in the trend, right? We crossed up above here in early April. You know, we are easily now 4.5 months into this intermediate run that we've had. Very, very strong move to the upside, well up above. See, the S&P, we're not above the 100% line yet. The NASDAQ, the 38% line is down here. For the NASDAQ 100, the 38% line is at the 100% level. The Russell and the Dow, we're just barely above the 78%. We can't even really get going above the 78% level. The Russell, you know, making it the first time. The Dow is the second time to get above, and it's not really able to take hold with any significance. And again, the S&P, which also got a cluster here in a mature run recently, is kind of showing signs of, you know, getting up to this all-time high tag might have been what this has been shooting for this entire time. In fact, today's move is a little bit more of a downward move than we had in a while. In fact, I mean, you look at the range, and the range at 29.88 points. You know, that's a couple days in a row of relatively well over 20 points. You know, before that we were at 8. Before that we were at 16, and here 23, and you know, a couple big down days and a pop up, and before that a couple of low 20s. So you know, a little bit of a bigger range than what we've gotten here in the past, and a little bit more of a downward move since that. You know, August the 11th and today, really the only two, you know, kind of significant down days, and neither one of them produced extreme lows on the momentum line. That's when you start to get concerned. Of course, that one was resolved with a strong overbought, just like these others. See, these are all resolved with overbought momentum lines, and that's fine if we get those. And this one does not have to be, because it didn't get down to an extreme. But getting down to an extreme and then following that up with, you know, a bearish near-term high point, especially, that's a red flag. That unless it's resolved by a strong overbought momentum line, you know, so as bearish as we got to get just as bullish on a short-term basis to resolve that, then that's your red flag that an intermediate posture change may be coming. Not just a weekly bearish, not just a light pink shading, but eventually the dark pink shading and a red line, right? That's an intermediate pullback. You can see how far down we have to go, but you know, again, in early 2018, when we last time we had a 5-month-long intermediate rally right here, we hit the 23% retracement level in 5 days. We were so far up above it, and that time we actually got to the 30-day moving average. This go around, we're going to be well below the 30-day moving average. So, you know, it might not even take 5 days to get down to that line. So just, you know, be prepared for that type of move. And again, it's going to require a catalyst, and it's going to be a catalyst that no one's expecting, because otherwise we would already be moving our way down there. So it's going to be a catalyst that nobody expected, and that's what usually produces the intermediate pullbacks. At least, you know, maybe it's something that people were expecting, but you know, something comes out and changes those expectations to be more bearish than what we originally thought, right? So it's got to be something that the market is not currently thinking about. So the upcoming election, for an example, is not going to cause the next intermediate pullback. It might create some volatility in the next couple of months, but things have to change, right? You'll have to get you know, a change in the pathway the market is already pricing in, right? Because the market has an idea of what's going to happen, what's going on, and prices in with all the available information it has until that information changes and they have to price in a different scenario. Or until they just don't have enough information to have an expectation, and that creates the most volatility because the markets don't like uncertainty at all. So again, you know, if and when we do get that drop to the 23% line, it's going to be quick, it's going to come out of nowhere, and it will be the beginnings of an intermediate pullback. And that might be as far down as we get to as well, is to that point, to this 31.11 area. And that might be, again, we might dip a little bit below it, maybe into this area here, but then that's it because of how strongly bullish we are. Alright, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit that red subscribe button that pops out. Also, there's a subscribe button down below if you're watching us on YouTube. That will notify you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us two things. You liked our video today and you want us to do another video tomorrow. If that's the case, let us know. One click you can do right now while you're watching. If that's not the case, of course, you don't have to click on anything. Also, comment. What questions or comments do you have about anything I discussed in the video tonight? Post those in the comment section. Join our website at marketscholars.com. There's a link popping out right there, top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content in between these videos from day to day up there at DavidSettle42. And join our Market Outlook Facebook group that we created. The address is up there as well. All right, if you're watching us here on our blog, here with this video here, check out our classes over here on the right. Our Q&A session is for our premium subscribers. I have one on Saturday morning as well. But all the rest of our classes are for all of our subscribers, our monthly and our premiums. There's our two different, our plus is our monthly plan. Our premium is of course, our premium plan. Also, if you're interested in following the trades that we do on the Market Outlook and continuing to manage those trades until we close them, I do that here in this Market Outlook live. Every day I do the Market Outlook, I do a live video at 3:30 Eastern Time. That's where you can get to it. Just click on that play button. That will take you there. It's also right here in the Market Outlook menu. Live trade review. Again, all of our subscribers get access to that, our premium and our plus subscribers. If you click on pricing, you can see the difference between the two. Our premium subscribers get access to those Q&A sessions, as well as all of our premium tools and access to our community, our class communities for all of our custom content, and you can be able to interact with other market scholars that attend the same classes. Also, come down here, click on this heart. It opens up this new window. Hit that like button right there. Hit on this thumbs up icon. That takes you to your Facebook page. Click on that like button. Again, the more you do that, it benefits us, because Twitter and Facebook will promote these posts to all of our followers, even if they're not online when these get posted. It benefits you because Twitter and Facebook will promote content in your timeline from the accounts that you engage with the most. So we try to make it really easy for you to engage with us here. All right, let's get back to the charts, and let's take a look at the long-term chart. And you can see a great candle, higher close so far, higher high so far, and no lower shadow, the three things you're looking for. And again, even there's a little bit of a smaller body, which means, you know, if we're looking at a 33.49 open next week roughly, then we're only, what, 30 points away. So it's setting up for next week to be a transition week on here, if this is how we finish, unless we get, you know, more of a bigger body, and depending upon where we finish by the end of the week, if we continue down or we finish closer to the 33.99 or even higher than that. So we'll kind of keep our eyes on that, and also take a look at the three green arrows, and you can see we have a red arrow, so we don't have three red arrows anymore. You can see a little bit of a bump in volume that we got, but those the red arrow comes from this MACD crossing below its moving average. Stochastics and its moving average are both above 80, so right now that doesn't really matter as much. And we are still easily above the 8-day moving average. So again, we don't really start to concern ourselves with the end of a run until we break the 17-day and we stay below it for a while. Right here we broke below it, we were back above it within a couple of days. Here we broke below it, we were back above it within a few more days. But we were back above it. So, and we had broken below the 30 and bounced right back up. So we need to get below the 17 and kind of stay there, and get below the 30 and not bounce back up, right? That's when you get the light pink shading and the yellow line. So neither one of those things have occurred yet. We're still, you know, above the 8-day moving average, and we have been since well before the August 11th low. That August 11th low also only got us to the 8-day moving average. So it's really been really all the way to July 28th since we've been below the 8-day moving average. So it's been quite a ride. And if you notice here, let me get rid of this MACD and let me bring up the PPO so we can see how far above the 30-day moving average we are right now in terms of price. So change that to 30. 30, and then go to simple moving average. So you can see here we're not as high as we've been, but we're relatively high, relatively speaking, to where we've been in the past, outside of coming off of significant lows. So here, let me edit that and put it at 2.81 so we can kind of see where we're at in the past here. So look at all of these, pretty much all 2019. That's about as far. Now you notice it didn't stop the trend. You know, eventually it did, but it didn't stop the trend. But it kind of shows it's, you know, it's really hard to extend away from the 30-day moving average if you go all the way across here when we are nearly 3% above it. Doesn't sound like a lot, but you can see that's until we get 20% below it, which leads to a strong, you know, even that only led to about a 7.5% move up above it. So, you know, in here we got about 10% below the 30-day moving average, and that only led to a move that was about almost 4% up above it. So it's hard to get too far up above the 30-day moving average unless you're coming off as sharp of a low point as you possibly can be. But you can see how you can be above it for so long. These are the intermediate runs, right? When you're above that 30-day moving average with a brief little pop, that was less than 1.5% right there. So again, getting below the 30-day by more than 1.5%. See, this one got to about 0.85% on that down day. But by the time we got here, that we were 2.38%. And then we hit the 30-day moving or the 23% retracement level, I believe, right there on this move. And 225 when we were down, I believe it was 225. We were 5% below at that time. So actually, I think that hit the 38%. This one actually hit the 23%, and we were 2%. Now we'll be, by the time we hit the 23% line, we'll be well below the 30-day moving average again. Right, the 30-day moving average is still rising. So we kind of keep an eye on the different layers. A little bit of a divergence showing up on the stochastics here, even though they're both in the reversal zone. And there's not the significance of the divergences when both the peaks are in the reversal zone doesn't take on a whole lot, but it does mean that you can pop your way down even briefly, like we did right here below the 17-day moving average before popping right back up. Right, it's when you don't pop right back up. So you pop down, pop right back up, pop down, pop right back up, pop down, pop right back up. If we don't pop right back up, then that's the concern, right? That's the concern that we're going to work our way down to the 23% line. See, even here, these two held the 23% both times. So if you break below that, that's a different story. And neither time did we do that, and that's 23% lines coming up pretty quickly, or it's got a pretty decent move down to get to that point. So by the time we're breaking the 30, it's not going to be the same as this one where we broke the 30 and hit that level. Here you break the 30 by 1.5–2%, and there's a pretty good chance that that's it, right? That's the beginning of our run. That could last us for a few weeks. All right, now let's take a look at the intraday chart here. We can see that we got there's our sell-off. In fact, closing at the lows yesterday, this is kind of an important level because that's where the volume is over the last week or so. So if we break, say, I don't know, maybe 335 and a half in that area, there's no volume. And the point of control is up here at the top. Look how big the value area is. I mean, that's how much room it has to run, with literally no resistance or support in this case. Nothing that can stop its decline because there's very, very little volume. And looks like obviously we filled in that gap over here. We still have this gap to fill in. So that's the key level. I mean, getting, again, below 335.5, we start filling in that gap. And then there's gap to fill in all the way down to the bottom of the value area. So very, very important that we don't go very much lower in the next couple of days. Otherwise, we're at least getting a move down to the 17-day moving average. And then we'll see what happens there. Remember, the 17-day moving average is right here at 332.78. Whoops, let's see, let's get that back here. 332.78. So let's go to the 4-week range. 332 is right, 78 is right here. So, I mean, again, if, and there's going to be a little bit of support there because that's kind of the last of the volume. If we can't hold that 17-day and float around with it and hold and bounce right back up above and start filling in that gap of volume, there is not a whole lot below to keep us from dropping. And again, I say that, again, the 23% retracement line is way down 310. So even the 4-week low is well above the 23% retracement line. So, I mean, that's a drop down to 322.5 seems like a bigger deal than it actually will be because of how big the run has been just to get to this point. Let's take a look at today's volume here. As I showed you earlier, it was a little bit higher, a little bit above the average. We haven't had that in a while. Again, August 11th. And then the lap before that, it was after this kind of near-term pullback and then we bounced up off of that. So a little bit of a increase, and we'll see how that plays out here compared to what we saw. See, on August 11th, we didn't get an arrow. This one we're finally getting one. So kind of stay tuned on that. The range, of course, 3 points, almost 3 points. I don't have to worry about any gaps here. So when you put those numbers into context, 67 million shares is right here, is above the average. 3 points is still, it's actually below the 1% mark. So we're still grinding our way down to the 1% level here on the ATR relative to price. That's going to be an important support level. Just like for volatility, you can see this 80% mark is an important level of being below that. It just shows how extremely oversold we are and limits our downside. I talked in our class today about this gap. Look how significant the gap is between implied and historical volatility, and usually that resolves as big as this is, especially with volatility being above 20. Usually when the implied volatility is above 20, historical gets above it pretty quickly. If not, it's already above it. So for the historical to be so low with implied still above 20 is very, very rare. And again, how does a gap like that get filled? Well, it gets filled with one of two ways. Either the VIX drops sharply, and we just saw the VIX is already sharply lower relative to the VIX 3M. So either that drops sharply, and that's a very low probability event, or historical volatility jumps up and catches up to it. And then something like this over here, and that takes a bump up in implied volatility first for that to happen. And then eventually you can see it catches up. So that's the more likely scenario. The question is if and when we're going to get something like that. And you can see, the ranges. Look how small the range is. We've only had a few, even 1% moves. Out of all these days, we've had 1, 2, 3, 4. That one got pretty darn close. Got to 0.91%. This one got to 0.86. So that'd be 4. Let's see, 1, 2, 3, 4. And then this one got to 1. So this is, out of all these days, you got a bunch of them right here. But starting with that one, 5 times. And really, after, if you count that with these highs, starting with this one, we only had 4 1% moves in all these sessions. Very, very, that's why historical volatility has gotten down so low. And usually that means implied goes down to something like this, right? Where implied historical goes down and implied comes down too, and fills in that gap that way, but not the case here. Not the case here. So especially considering how extremely low it already is, that's something to keep an eye on in terms of watching a jump up to this 100% mark. I showed you that 2018 time frame before when we jumped up to on that February the 2nd here, we jumped up we fell down to that 23% retracement level. We got to the 100% mark in those same 5 days. So we were pretty low, and then we jumped up to the 100% mark just like that. And from this low point here, 1108, up to 1731, that's a 56% increase in the volatility index. If we get a similar 50% increase, we're looking at close to 35 here on the VIX. And then you saw what happened after that, right? So what happened after that, right there, see that's February the 2nd, you can see the big moves we had after where volatility got up in the 30s and the 40s. So something very similar can occur here, just like that, right, within a matter of just a few days, especially considering that we have an options expiration coming up here. Whether it will occur before or most likely after that, definitely something to keep our eyes peeled for, because that's becoming an increasing likelihood considering how volatility has been behaving lately. So to summarize the technical outlook, the posture is still strongly bullish, and we are grinding. We are in grind mode, but the longer we grind, this tornado of a 23% retracement and a jump in volatility is going to come out unexpectedly within a matter of just a few days. And so, the likelihood of something like that happening, especially compared to the reward potential of any new directional bullish trades, that's a pretty decent sized risk that we have on any new bullish trades that we have, or any bullish trades that you might have quite a bit of profits on that we haven't locked in some of that. So, again, doesn't, I don't think it will happen tomorrow. It might not happen by the end, most likely won't happen by the end of this week. But it's something to pay attention to and be aware of as we get closer to expiration and then beyond of when something like that can happen. Because the conditions of that happening are getting, with extremely low volatility, with a tremendous gap between historical and implied volatility, and how high we've been away from the 30-day moving average. A lot of things are setting up for a possibility for that relatively quick and deeper retracement than we may be comfortable of, simply because of how big the rally has been. Right, it won't be that big of a deal, but 23% retracements usually are nothing. They're not even a retracement. It's just pullback. It's just noise. But considering how big the rally has been, 40-50% moves in 120 days, people have said, that's gonna create deeper exhales than what we're comfortable with. And one of those is coming up sooner rather than later, and we just need to not be caught one-sided in the market when that happens. All right, now let's talk about what's driving this price action here. So let's bring that chart back up. There we go. And take a look at our asset class comparison. Let's take a look at how it's going here this week. So let's go to August. From the beginning of the week so far, we're 3 days into this week. You can see, the Qs again, have been very positive performer. But look at commodities. Commodities finally doing, a better job of they've been such a laggard. They've been holding up very well. Gold also did well with this drop in the dollar that we've had early in the week. Didn't really help small cap stocks very much. And you can see large cap stocks did okay too. But as soon as the dollar started to rally, commodities came down. Gold really came down today. Real estate dropped sharply today. Those are some pretty significant moves. If I just look at today alone, look at the dollars up, everything else down. Emerging market stocks down sharply, real estate down sharply, gold down 3%. Long-term bonds, interestingly enough, were down. So even they didn't get spared. With risk appetite rising, usually yields go up when stocks go up. Not the case. The stocks and bonds, everything dollar denominated went down. The dollar was up almost 1 full-on percent. To kind of give you an idea of what that looks like here on the Euro US dollar chart, you can see, that's a pretty decent size engulfing pattern there. And we had a little bit of an evening star candlestick. We might be in the mode where the dollar is starting its retracement. Of course, that's the time. We were kind of expecting that the dollar would have a bullish run when stocks themselves started their own intermediate pullback. And so here's the move. I can't really see it there with today's move on there. Let's see if I can, there we go. So there's the move. So you can see the momentum line really got down to a sharp low, the near-term line down as well. You still do have a strong intermediate posture, and market sentiment's close to 80, but it's that's a pretty deep. As much as you can get with 24-hour trading here to get an engulfing pattern, that's about what we got on this chart with a pretty decent size. In fact, we almost engulfed 2 periods here. So I think there's a pretty decent chance that is our sign, right? Our sign that the dollar might pull back at least to the 23% retracement where the 30-day moving average will be at the time, if not down to the 38. And like I said, coincide with the intermediate pullback in equities at that time. So you take a look at yields, and yields didn't really respond. Now, yields had pulled back earlier, but you can see that the intermediate posture is strongly bullish. I got dark green shading and a green line again, even if we're not necessarily really taken off, but we did get a near-term pullback in these 3 days. It did stop short. We got a little bit of a bullish intermediate confirmation signal. So if we get some rising yields along with this intermediate pullback, that will be a sign that the intermediate pullback won't be that big of a deal, right? Maybe even just stopping 23%, maybe a little bit below that, and that's it, right? So that will be a positive development for broader risk appetite as a whole too. I told you about gold. The gold had a big down day today, coming down to its moving average, light pink shading again, and a big time short-term sentiment drop. So we'll see, but it's sitting on its support. So we'll see how much more lower it goes with dollar strength. It seems like it priced in a lot of dollar strength today. And then you can see crude oil. I mean, look at the grind crude oil has been going on. Very, very low volatility. In fact, if you come over here to this chart and we take a look at crude oil, and you can see that its historical volatility is so low. It's down to practically nothing, less than 0.2%, and the implied volatility is coming down as well after such a big gap there, coming down. And you can see on a percent by percent move, we're just not getting very big. I mean, we've had some 2% moves down, some 2% moves up, but again, we were getting 3% moves or more previously. So that kind of puts in context the type of move that we're getting, that where volatility is at. I remember the volatility for the SPX is at 10%, and this is just below 20, and the VIX is at 22, and the VIX, implied volatility for crude is at about 38%. So it kind of shows how much more volatile crude oil is, and it's been such a laggard coming up, but it's still showing strong bullish posture. And you can also see too the intermediate line getting back above its market sentiment line. You would expect this to lag anyway, because that's what it does. It doesn't go up with stocks always hand in hand. A lot of times it will keep going up while stocks have already rolled over, and sometimes it rolls over before stocks did, and that's what happened here. It rolled over and gave us an idea of what was happening globally from an economic perspective before stocks finally hit the fan post February expiration right here. Let's take a look at the global markets and take a look at the 12 grid for the biggest economies that are out there. Again, look at some light pink shading, yellow line on China. So we got dark pink shading and a red line on Brazil. All the rest of them still dark green line, but you see starting to get a little bit of diversity in colors here, and that's just something to keep an eye on, and a sign that we might be getting some broader global weakness along with that strength in the dollar. Again, nothing too alarming or concerning. We're not going to fall off a cliff, but it does show that we might be a lot closer to this intermediate weakness than what we've seen, especially again coming up on close to 5 complete months. And even if we do start to pull back, even if this is the slow beginning of an intermediate drop, it still might take another week or two before that intermediate line finally does cross below 50, depending upon how fast we fall to that 23% retracement level. So that kind of gives you an idea of this, how long we've been this strongly bullish off of that late March low point. All right, now let's look at the sector rotation and see how they're doing this week so far. Let's see here, it'd be custom, and let's come down to August 17th. Okay, and then so far this week, again, it's the three main drivers: communication services, technology, discretionary. They've continued to lead higher. Unfortunately, we're not, the economically growth sensitive areas, materials now negative for the week. Energy has been sharply negative for the week. Even with commodities not having a bad week themselves. Financials are down, even with yields starting to have some kind of bounce. Financials are down, industrials, even the safe havens, the interest rate sensitive areas are down, of course, again, because of the little bit of a rise in yields, right? Putting pressure on those interest rate sensitive areas. The dollar sensitive areas down too. Staples and healthcare kind of matching the weakness in the market. So again, it's continuing to be this leadership in this large cap tech areas, and not just in the big FANG names. There's a lot of large cap tech names, or there's different, especially different industries within the tech sector. They're doing really, really bullish right now and still hanging on to some very strong gains, and that's typically what happens at the end of mature runs. They, the weak hands are looking for the top performers. They're not looking for the mediocre performers. They're looking for the top performers, and that keeps them afloat. And as of right now, especially with Apple hitting that 2 trillion mark, that, when it hit the 1 trillion mark, that was kind of it, right? There was a bout of weakness there. Now that we've hit another big round number at the 2 trillion mark, that might be the top, so to speak, where these kind of run out of gas now as they hit these really high valuations, and now the larger institutions start to take some of their profits and shake out some of the weak hands on the way back down to those retracement levels. For the NASDAQ, remember, getting down to the pre-COVID highs would be a 38% retracement. Alright, so that takes us to our trade idea of the day. It's actually a combination here of this tech space, this kind of thin tech space, a weakness as well as strength, and that is MasterCard. MasterCard got a nice little bullish trend going, a nice strong bullish posture, bullish long-term chart here. It has a bullish 3 green arrow chart, right? We have all 3 green arrows, even if we're kind of close to a red arrow on the MACD. But that's okay too for the type of trade that we want to do. You take a look at some of the other oscillators. The RSI is easily above 60. It has been, so we've been kind of holding up there. The DMI is looking bullish as well. Strong positive index, very good negative index is giving us a rising ADX up above 25. The trend strength indicators are showing strength, right? We're above 80 and almost above 5 on this. So well up above the cloud, even well above the blue line, which is the 26-day midpoint of the 26-day range. In fact, the red line's well above. So very strong bullish patterns. But again, the question is, directional opportunity. How much is there? And that limits our upside, even with the stock trading up above the value area here. But you can see, there's some pretty strong support below us now too, because the value area is down there. So with that being said, we can say, okay, well, let's do a trade that will give me a little bit of upside potential, but will give me a little bit of upside potential. So we'll sell the 350 call and buy the 355, and that gives me some room up to the upside to work with from 332. But it also gives me some downside room in case there's any kind of weakness, or both, an upside and a downside move by September expiration. So I'll sell the 315, 310 put. The combination of those give me, let's see, let's get rid of the working order down there, and you can see the order that went through for a normal position size, because we don't have to worry about earnings, giving me about a 50% return on risk there. And you can see where those slices are. That's where these blue lines are. So if you take a look at the Bollinger Bands, you can see that lower blue line sitting right on the value area, and the upper blue line is just a little bit above the old high, the pre-COVID high. So it gives me some room to work with to the upside with very minimal risk up above it, and it gives me some room to downside, and with a little bit of risk below it too, that goes even to stronger support, where there's a pretty decent volume node down there. So an opportunity to just kind of grind our way towards September expiration, and a good strong stock like this, it's on a good strong trend. Alright, well that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread there, reply to anybody else's thread, and let's keep this conversation going in between videos. As always, thank you very much for watching. Subscribe to our YouTube channel. Hit that thumbs up icon down below, as well as on Twitter and on Facebook, and then comment on our video. Follow me on Twitter for more content between the videos, and join our Facebook group, as well as our community at marketscholars.com. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.